Well, everybody, I'm Cantonese Cat. Hey, everybody, Cantonese Cat here. We've had our rate cut. We have had a pretty positive reaction so far. And we've got Tom Lee here. I want to do a reaction to Tom Lee. I love Tom Lee. A lot of people think that he's a little bit too bullish. So let's hear what he has to say here.
Stocks are rallying here on the back of the Fed's rate cut. Our next guest likes industrials and financials here. Fundstrat Global Advisors Head of Research and CNBC contributor Tom Lee joins us on the phone. Sticking with his target of 5,200, Tom, I know you agree the cycle has started and there is a Fed put in place, but it doesn't sound like you're willing at this moment to add a lot more risk.
Good morning, Carl, and thanks for having me. You know, Carl, I've got, I think, two time frames. I think what Steve said about the recalibration is really important because I think investors also need to recalibrate. There are too many that were in the camp of a hard landing coming, or the Fed would be too late. And this Fed cut cycle, I think, is setting the stage for markets to be really strong over the next 1 month or next 3 months.
First of all, I want to just make sure that we are clear here. A lot of people have already been calling for hard landing for a very, very, very long time. A lot of people worry about inflation, hard landing for a very long time. But the S&P 500 bottom in October 2022 is around, the SPY is around 350 when it bottomed. Right now it's 568. A lot of people still worry about the hard landing. The narrative sounds good. I mean, like, you have to worry about what the Fed does, and every single time, you know, all this stuff happens, that happens, right? Except that everybody's been wrong for the last 5 years, and everybody's just kind of been thrown off sides, maybe probably longer than that. I mean, like, everybody's just kind of following the same narrative. And when everybody does follow the same narrative, it really does make me very, very skeptical in terms of what's happening. I did make a post on X. Basically, I'm admitting to the fact that I am an idiot. But hear me out. Unemployment spiked huge in 2020. You have inflation, the greatest inflation for the last 4 or 5 decades that happened in 2021. NASDAQ and IWM have deleveraged significantly in 2022. Bonds have significantly deleveraged in 2023. And you really haven't had any deleveraging of bonds for a very, very, very long time. This was like the great bond deleveraging that kind of needed to happen. And some banks were thrown off sides because of it. But you know what? Banks are too big to fail anyway, but they were able to deleverage bonds, which is great. This is actually great news. And on top of that, you have a bunch of stocks like the Dollar General, Nike, Celsius, Hershey's, that have just kind of ran up for years and years and decades. And they've finally had a chance to just kind of decompress and deleverage here a little bit in 2024. And that's what you're seeing. Like, this is really nothing that's terrible. It's all about, like, you know, deleveraging. Banks don't really seem like they're going to fail now, is there? I mean, I'm not really hearing any concerns there. You know why that is? We're going to talk about why that is here in a second. What if these cautious narratives are due to recency bias, what happened over the last few years? What if it's not normal to have crashes, like 3 crashes within 5 years? In 2018 with the tariffs, 2020 with COVID, in 2022 with the great deleveraging of Bitcoin, NASDAQ, IWM, everything. And what if this is a perfect setup because all these things have been deleveraged for you to really go up a lot higher on the wall of worry, for higher and longer than a lot of people expect, is a potential. There's such a thing as a downside risk, but there's also such a thing as an upside risk. I'll show you what the upside risk is. When Jamie Dimon was talking about the economic hurricane in June of 2022, if you would have bought, you down here, you would call yourself stupid a few months later, right? Because it did go lower. But if you would have bought and just held, because he was warning you about the economic hurricane, the hurricane has shot the stock market way up from that point. If you were to listen to him, I don't know why you're not mad at him right now. I mean, obviously, like, if anything, he's the CEO of one of the largest banks. Technically, it's financial advice, But it's kind of funny, isn't it? Like, why didn't he? He was actually quite bullish going into 2022. Why didn't he mention that? Why didn't he mention there was an economic hurricane when things just kind of shot way up? Why did he not mention that? Anyway, hard landing. Let's keep going.
But what the stocks do between now and, let's say, the election day, I think is still a lot of uncertainty, and that's the reason why I'm a little hesitant for investors to dive in. But if I was going to advise where to be positioned, Carl, it's exactly what you said. It's cyclicals, which is industrials, financials, and small caps.
Right.
It's interesting. I think Tom Lee, he does run a fund. He does have a lot of visibility. And you do have to be cautious of the short-term volatility if you want to time the market. If you really think that timing the market is better than time in the market, then you can. And the very fact that we are very near, if not, we just made, like, we're right now at the all-time high here for the month. So I can see the argument of being cautious, but I can also see that because of the rate environment, I can totally see why you want to enter the cyclicals, the IWM, the financials like XLF, and the industrials like the XLI. I can totally see that. Now, the problem with the whole narrative about what the Fed does this, what the Fed does that is, so you look at the federal funds rate, right? The effective federal funds rate, it has remained at close to about 5.2, 5.3% for a very long time now, right? It's been about 5% for the entire, I would say almost a year to like about 16 months or so, right? So why is it when you have rates higher for longer, and they really did do higher for longer, why is it that the stock market kept going up? Because you have a lack of liquidity, lack of access. Now, you can say that it's because inflation's been going down, and inflation has no doubt been going down. I mean, just look at oil. Just look at US oil, and that already tells you the whole story about where the pricing power is. It's not in oil. It's just been basically making all these lower highs, and it looks like a little bit of dead Canadian bounce here, dead Canadian bounce here, and it looks like it might potentially fall back under into the 60 zone. Inflation per this chart is beaten already. Inflation per a lot of metrics has been beaten already. Now, the other thing too, if you look at the GSG, which is the commodity index, it looks weak. It just looks really weak. Now, it does look like it might be finding some support over here, but it just looks like it's just doing like these, kind of bounds over here. So currently, there's not really any threat for inflation. We really haven't had any inflationary environment for about like 40, 50 years. And there's a lot of reason for that. It could be because of innovation, because of China, it could be because of a lot of different things. Right now, the Chinese economy is not doing well. Europe's not doing that great. Japan's not doing that great. Where's the inflationary forces coming from? Is it just from global liquidity going up? Global liquidity keeps on going up over time. Does it always cause you to have inflation? Let's look at it, right? So I'm going to pull up the M2 global liquidity supply. A lot of people think that for the period of 2020 and 2021, it was like a very unreasonable period where things just kind of went way up in terms of global liquidity, and that's why we're having such inflation. No, not really. If you just look at the commodity index, you actually see that overall from the beginning of this index from 2006 going all the way down to current, commodities really have just been going downhill over the last 20 years or so until COVID hits, right? And that might be more of like a supply shock than anything. And in combination with the fact that they did increase global liquidity, right? Okay, fair. So you have a huge run from commodities from like the 7s all the way up to like the 25s. Is that going to be sustainable? I don't know. Is the global liquidity just keep on shooting up? No, it's been going up more or less in a straight line. And you had a little bit of quantitative tightening over here, but right now you're already broken through. Like you're basically having some brand new all-time highs here for global liquidity, right? Does it make sense that you have, if you increase in global liquidity, doesn't necessarily mean that you're going to have increased inflation? The answer is no. And all of these narratives are saying that, if they lower rates, it's going to cause a lot of inflation. That's I don't know if I can buy into that narrative. The other thing too is you wonder why the stock market has gone up. You wonder why there's increase in access to liquidity. You know why, even though there's higher rates for longer, why the overall global liquidity didn't really just plummet, and why it stays at a certain level. It is making a little bit of an ascending triangle over here, looking like it wanted to break up, and it finally did break up. Why did it happen? Well, it's because the federal funds rate is just a guide, right? The real market determines rates. For example, the 2-year, right? I already mentioned the 2-year yield has peaked around October, and it's been plummeted since then, right? 10-year also peaked around October, plummeted since then, right? IWM bottomed October 2023, right? Gone up a lot since then, right? SPY had a little pretty important bottom over October 2023, gone up since then, right? Let's see, like ARK fund, right? ARKK fund, right? Where did bottom over here on the local bottom? October 2023. Why is that? Because that also seems to be coinciding with a very important low here on global liquidity. But overall, all these narratives are saying that, hey, you already have improving access to capital because real rates has gone down. And I can also, I keep on talking about the same thing over and over again. I almost feel like, but you have to know this, right? I have to beat this into your head in terms of what I'm thinking. Guess what happened when you have rates, real rates, not effective federal funds rate. I don't care about that. Real rates. What happens when you have the 10-year yield going all the way from about 7.8, sorry, from about 5% all the way down to about 3.6, 3.7%, right? What happened to the mortgage rate? Is the mortgage rate just going to stay up higher because the Fed funds rate is super high at like 5% for the last 16 months? No. It peaked out around 7.8%. Now it's 6.1%. And before the rate cuts, it was like 6.2%. So it's already come down a lot. Like it's already plummeted down by about like 20, 30, 40% just over the last year or so, with the Fed doing absolutely nothing. The real financial market is already taking care of you. You have these mortgage rates going down, your global rate going up. So I really don't know why people pay so much attention to the Fed. But with that said, it's a good narrative. It's like almost like the market's maybe guessing what the Fed's going to do and just kind of front running it. I don't know. I'm going to keep listening to this.
With a preference for that over your traditional Mag 7 tech AI build out trade?
I think tech and Mag 7 still keeps up with the market. And that's why if someone owns it and they have tax implications, I wouldn't sell it. But for all these folks that have been sitting on defensive positions or thinking the Fed cut was going to be too late and the market was going to, equity markets were going to fall, I think those folks have to allocate into cyclical stocks, especially small caps, because they are not only sensitive to the cut in rates because of variable rate debt, but they're going to benefit from the cyclical boost to the economy as mortgages, the cost of mortgages drop, auto loans, credit cards, the lift to the consumer, potential M&A. All these are big tailwinds for small caps.
He is a big proponent of small caps. I am as well. I've been talking about it for closer to like a little over a year. I'm a big proponent for small caps. The reason why is not necessarily because of the federal funds rate, not necessarily because of any of the narratives you're going out there. It's very simple. It got deleveraged during 2022 significantly, and you've had whales that have been accumulating for the last two years or so. Like this is a big accumulation zone. There's no doubt to me that whenever they accumulate for 2 years or so, and when the economy, when things are not that bad, when you also have an increase in global liquidity, things are probably going to end up going up, right? These wells, they didn't just accumulate down here. I mean, they didn't go straight down to like the 90s. It held up here because there were, whenever you have somebody selling, they have somebody buying on the other side, right? And when you have somebody buying on the other side, somebody's going to end up making pretty decent profits when they buy low and eventually sell high. We are looking at the IWM really is showing a lot of strength for the most part over the last year or so. It's just been forming nothing but higher highs and higher lows. You got these huge demand wicks down here on the monthly chart, right? So this is one area I do completely agree with Tom Lee. I think it's going to outperform. I think anything that's right now the market space is saying anything that's under 220 is a good deal. But anything under 220 is getting bought up. There's a huge demand on here for 2 months in a row, right? Is that always going to be the case? I don't know. But there's huge demand right here for about 2 months in a row. The other the other sectors are recommending financials. I'm like, I'm okay. The XLF, which is the financials fund here, it's already kind of ran up a lot. I think it probably still has some room to kind of go up, but I don't know whether or not I want to get into this because, again, when you're talking about things that just kind of gone up a lot, you worry about potential leveraging, right? I like things that are a little bit more deleveraged. I like things that people are not really talking about, people are not really answering. I guess financials is still potentially a good way to get into it because you're going to have some increase in global liquidity, just like how you have increase in global liquidity over here. The financials did excellent, just like how you have had increase in global liquidity really over the last 10 years, and financial has been just doing absolutely amazing, right? But I just don't like to kind of get into things that kind of ran up a lot. Same thing with industrials. I think industrials, you're never going to go wrong with industrials in US stocks because the government keeps printing money and they keep spending and they keep making new projects for like Caterpillar and other industrials to profit from. Like, so you can never really go wrong with going with the industrials. And as a matter of fact, if you were to gone into industrials for like the last 10 years, I think you would have get close to about tripling your money, right? So that's actually not a bad thought either. And the industrials actually look very similar to RWM, right? The only issue is that I think it's already kind of ran up a lot when I think that IWM may still have a lot more room to go. And if there is a lot of financial easing, there might be a lot more potential upsides for IWM moving forward. That's kind of my view on this, but let's keep listening to Tom Lee.
I guess then the risk to this, Tom, is that inflation comes back, right? If you're talking about this big cyclical recovery because of what the Fed's doing.
That's true. But I think one thing investors have to distinguish is that real growth, like GDP growth, doesn't mean inflation pressures, because inflation is, a mismatch of supply and demand. And I think there is a lot of excess supply potentially coming. For instance, housing could have a supply response. And if you look at the two biggest drivers for inflation for the past 8 quarters, it's been shelter and rent rolls and auto insurance. And auto insurance, I think these insurers have reached sufficiency, so you're not seeing the premium increases anymore. So unless the rest of the CPI basket accelerates, inflation is actually falling pretty sharply.
I just mentioned that printing money doesn't mean inflation, and she's just bringing that as like a question, I guess. I don't really believe that inflation is necessarily going to come back. I just don't. The only thing that hasn't been deleveraged, you're talking about deleveraging of everything already over the last like 4 or 5 years, right? You're talking about deleveraging of unemployment rate being so low. Like it was absolutely insane. Anyway, we're going to talk a little bit about unemployment in a little bit. You're talking about deleveraging the Nasdaq, deleveraging Bitcoin, deleveraging crypto, deleveraging bonds, deleveraging these other stocks like Chipotle, Dollar Tree, all of these stocks. But one thing has not been deleveraged yet, even with the rates being so high. Housing, that has not been deleveraged yet. I would not be surprised if the rest of the financial sector, because this is a little bit more like a rolling recession, unlike everything recession. This is a little bit of a rolling recession where one thing gets hit hard and another thing gets hit hard and another thing gets hit hard. This is actually creating a lot of opportunities in the market. But the one thing that still hasn't really been hit yet really is housing. So I would not be surprised if housing ends up getting hit and the rest of the economy actually does pretty well. This is going to be hard for people to kind of wrap their head around, but I don't know how else to kind of say that. Do I expect housing to hit hard? No. I think it might end up getting hit a little bit, and it's going to be a little bit counterintuitive, because if rates are going down, you imagine the mortgage rates going down, you're going to imagine that housing is going to do better. But I'm just saying that it doesn't always have to work that way, because that's one thing that hasn't really been deleveraged yet. I'm sure if it ends up happening, they'll come up with some kind of narrative to try to justify it. So I'm not going to tell you what I know or what I don't know, because it doesn't really matter. But that's just one thought.
Hey, Tom, on the labor market, we're going to get 2 prints before the November meeting. Some of these doves are arguing that labor is going to force a faster pace of cuts because historically they argue the change in monetary policy doesn't get felt in the labor market for 4 quarters, and the peak impact is not for 8 quarters. I wonder if you agree.
I mean, I don't think there's anything wrong with people looking at the history of labor markets, especially as people know, as labor markets slow, it has a cycle of its own. The one thing that I think we have to keep in the back of our minds is that CEOs have been cautious for the last 2.5 years because the Fed telegraphed a tightening cycle to fight inflation. So I think that the fact that rates and now we're in an easing cycle means that companies are going to actually start doing expansion. So I think the labor market and the Fed is mentally knocking down these monthly numbers. I think tailwinds are emerging for labor markets to actually strengthen.
Yeah.
I think this is it for the video. I think they were making the assumption, and everybody makes this assumption, if unemployment goes up, the economy goes down and stock market goes down. Again, I'm going to say that the presumption here, why this guy asked Tom Lee this, is because the assumption here is unemployment goes up, stock market goes down. Is that the case? Well, I don't think so. I basically just did a chart here about like an hour ago. I was looking through the unemployment rates and I was comparing that to the S&P 500. This is like the worst predictor for the stock market crashes. Unemployment rate is like the worst predictor of stock market crashes. You know why that is? It's not a positive indicator. There's no positive correlation. There's also no negative correlation either. Just looking at like the last 50 years data, half the time when you have unemployment going way up, half the time stock market goes down. The other half of the time, whenever you have unemployment going up, stock market goes up, right? Unemployment goes up, stock market goes up. Unemployment goes up during the dot-com bubble, stock market goes down. Unemployment goes up during the Great Financial Crisis, stock market goes down. Unemployment going up during COVID, stock market goes up. It's probably the worst predictor there is because this is like 50 and 50. Like there's not any positive or negative correlation. It's just absolutely useless. What they're saying is correct. I do think that there is going to be a little bit of 4 to 8 quarters of lag here in terms of what the federal funds rate changes in terms of how it impacts the market. They're not wrong because just look like the market is probably already a lot more responsive to rates and yields than unemployment rate is. Usually employment rate is a lagging indicator. So just because unemployment is peaking up, you know what that means based on what I'm looking at the data here? That means about 50% of the chance you're going to have a recession and stock market going down, and 50% of the chance that the stock market's not going to go down, it's going to go up. So I would just say don't worry about it. I mean, like obviously you employ, you worry about your job, you worry about employment rate going up, you worry about the actual things that are happening in the real world, then that's a different story. That is concerning. I think that there are some rolling recessions that's been happening over the last 4 or 5 years, and it's not right. It's hard times right now for a lot of people. It's not right. But if you're talking about the stock market, I don't know. I mean, like I just think that people just make these assumptions that are like something happens, it has to cause another thing to happen. I don't think the world works that way. I think that's why a lot of people end up following these narratives and end up being thrown off sides because of that. Just look at the data. Unemployment doesn't tell you anything. Don't worry about unemployment unless if you're employed and you worry about your job, right? Which is a real concern. I'm going to finally say this one more time. Rate cuts by the Federal Reserve does not mean that the stock market is going to go down. I'm going to say that one more time. Rate cuts, the start of rate cut cycle does not necessarily mean that the stock market is going to go down. Matter of fact, the majority of the time when you have rate cut cycle being started, the stock market goes up. A lot of times, a lot of these instances, it goes up a lot higher. And this has been the case really since the 1960s all the way up to today. How many rate cut cycles? Okay, so let's say okay, big cuts, small cuts, I don't care. You have a big cut over here during COVID, and the stock market just kept going up, right? So there are two instances that there are the exceptions where the rate cut cycle has started, and the S&P 500 has also gone down a lot, right? The rest of the time that's not the case. The rest of the time we have rates being cut, the market loves it, right? So what makes it so different with these two times, and why do people always horn and focus on these two times? Because they have recency bias. These two instances here, dot-com bubble and the Great Financial Crisis, are happening within the lifetime. A lot of people, a lot of CNBC talking heads are still out there talking. They're still talking about it. And that's why they are worried that that's going to happen. But even within recent history, all of these different federal funds rate cuts are not corresponding to the stock market going down. This has only happened really twice. When I was kind of backtesting the data, it really only happened twice. And both of those events are not because of federal funds rate being cut. Both of those events are because of deleveraging is much needed. S&P 500 had gone up 5 years straight, way outside the 6-month upper Bollinger Band here, way overextended here from 1995 all the way to 2000. It needed to be deleveraged. There were just a lot of irrational exuberance out there that it just needed to be deleveraged. And that's what they did. They deleveraged it, and the Federal Reserve cut rates to kind of soften the blow. Now, what happened over here in the Great Financial Crisis? They over-leveraged housing, right? They over-leveraged housing loans, and everybody's buying like 5-6 houses, thinking they're going to make a lot more money from it. And guess what? That needed to be flushed out. What's happening right now? Are there just too many people buying chips and stocking their own home and like doing nothing with it? Are these companies shell companies over here on like the S&P 500, where you're worried that they're just really there to do nothing except to grab your liquidity and to say that they're doing something rather than changing the world? Is Apple a shell company? Is Microsoft a shell company? Is Google a shell company? Is Tesla a shell company? I don't understand the narratives that are going on out there. Is because I'm dumb. If you want to be dumb like me, think like me. If you want to be smart like them, think like them. But one thing for sure, I was dumb enough to try to buy IWM down here, and I was dumb enough to try to buy T-Triple-Qs whenever Jamie Dimon was telling me that there's an economic hurricane coming. Matter of fact, when I hear him talk, I just want to buy more T-Triple-Qs. That's what I want to do. Anyway, I'm a little bit feisty today. I just want to get it out of my chest here. Thank you so much for listening. You guys have a great weekend.